Okay, so, you're making plans for the future, right? You're trying to get ahead of things, and then suddenly something unexpected just wham hits you, right?
Yeah, that's inevitable.
And in business, these unexpected things can have a really big impact on your finances. So for you, the listener, it's not just about being aware of what could happen, right? It's about actually understanding how to sort of build up a shield against these financial, meteorites coming in.
Right. And that's precisely what we are delving into today. Um, Risk insurance.
Risk
And
insurance.
this isn't just a box ticking exercise. This isn't just paying your premiums and hoping for the best. This is a key fundamental pillar of what we call enterprise risk management, or ERM.
ERM. Okay, so let's sort of back up for a second here. It sounds very comprehensive. What does that actually mean for you, the listener, who's, trying to run a business?
So think of ERM as your organization's way of taking a really good look, in the rearview mirror, out the side windows, and all the way down the road. Um, it's a systematic way of identifying all the good and the bad that could affect your ability to reach your goals, and then putting plans in place to actually deal with them effectively.
So it's really that sort of big picture view of potential turbulence. And for you, the listener, where does insurance fit into this?
So imagine you've identified a significant financial risk.
Hmm.
Okay. Let's say a natural disaster affecting your main warehouse. Risk insurance is a really structured way of handing off that financial impact of that specific risk to an insurance provider. You pay a regular premium, and in return, the insurer agrees to shoulder some of those financial losses if that disaster actually occurs.
Right.
For you, this means safeguarding your financial stability and allowing your business to focus on what it does best,
Wow.
on its core mission, right? Okay, so today we are going to really try and understand how this financial risk transfer actually works, especially within this framework of ERM. We're going to be drawing from an article that examines risk insurance through the lens of ISO 31000.2018.
Yes.
And if I remember correctly, that's like the gold standard for how organizations should be thinking about and managing risk.
Yeah, exactly. I mean, ISO 31000 provides our listener with a set of guidelines, best practices, if you will, for setting up, putting in place, and continuously improving your risk management approach.
Right.
And we really want to show you how risk insurance fits in as a practical tool within this framework. How do organizations decide which risks to insure?
Right.
And why is this such a fundamental part of a smart business strategy?
Okay, so it feels like we should take a quick detour here into the history books, because I'm assuming insurance isn't something that, just sort of popped up overnight, right? It's got to have some historical roots. Yeah, you're spot on. This fundamental idea of sharing risk is something that's ancient. If we go back to the earliest examples, we can trace back insurance all the way to Mesopotamia.
Wow.
Merchants had systems in place back then, informal contracts really, to spread the risk of losing their precious cargo while it was being transported.
So even back then, the concept of not putting all your eggs in one basket or all your goods on one potentially leaky boat was a smart one.
Absolutely. And, that concept continued to develop. In ancient Greece and Rome, with their vast maritime trade networks, we start to see more defined, albeit quite basic, insurance-like mechanisms to protect against those very real dangers of shipwrecks and even piracy.
Wow, talk about risks with some real, teeth to them.
Absolutely. Now, if we fast forward to the Middle Ages, with that growth of international trade, you start to see more formal insurance markets beginning to appear, particularly focusing on marine insurance. This is a huge leap towards the sophisticated systems that we see today.
Right. So then when do we get to the stage of having actual insurance companies as we would recognize them today?
Yeah, so the 17th century was a turning point with the establishment of the first modern insurance companies. And a key example that comes to mind is Lloyd's of London, which emerged in the late 1600s. It played a vital role in underwriting those sometimes perilous maritime voyages.
Right, and it's still going strong. I always picture that very distinctive Lloyd's building in London, and it's fascinating to think that it literally grew out of the need to financially safeguard ships crossing the oceans.
And then the Industrial Revolution in the 18th and 19th centuries acted as a major catalyst for the insurance industry. The rise of factories, complex machinery, brought with it a whole new set of risks. The threat of fire equipment breakdowns and workplace injuries. So businesses needed a way to protect themselves from these significant new potential losses.
Right, so as industries became more complex and more intricate, the ways of dealing with their inherent risks also had to evolve.
Exactly. However, it wasn't until the mid-20th century that we actually saw the formal emergence of risk management as its own distinct professional field. Initially, this was very much focused on operational risks, with insurance being the primary tool to deal with things like property damage and liability claims.
So for a long time, insurance was seen as the answer to managing business risk.
Largely, yes.
Hmm.
But, as businesses became increasingly interconnected and started to face broader, more strategic risks, things like market shifts or damage to their reputation, it became clear that just relying on insurance wasn't really a comprehensive enough approach.
Right.
And that's what led to the development of enterprise risk management in the late 20th and early 21st centuries.
Which brings us back to ERM, right? So for the listener, how does insurance fit into this more modern and holistic way of looking at risk?
So within ERM, insurance is still a vital tool, but it's used in a much more strategic way. Organizations now carefully weigh the cost effectiveness of transferring specific risks through insurance against other options, like avoiding the risky activity altogether or putting in place very robust internal controls to try and minimize the likelihood or the impact of that risk.
Right.
It's about using insurance intelligently in a targeted way as one piece of a larger risk management puzzle.
So it's not just about, buying up every insurance policy you can find. It's about making these informed choices as part of a bigger plan.
Precisely. And, despite this evolution in how we think about risk insurance's fundamental role in managing uncertainty and providing that crucial financial protection endures.
Okay, so we've established, where insurance comes from and how it fits within this bigger picture of ERM. Now, for you, the listener, why is it actually important? Why is this so crucial?
Well, the real importance lies in this concept of risk transfer. Okay. So for what we call hazard risks, things like fires, floods, liability lawsuits, insurance is a primary method of risk financing. You, as the insured party, are essentially transferring the potential financial burden of those risks onto the insurer.
Right, so they're taking on that risk in exchange for you making your regular premium payments. It's that fundamental exchange of, potential pain for a kind of predictable cost.
Exactly. And the basic principle is that the insurer agrees to pay you a specific amount if certain predefined events actually occur. And it's also important, I think, for you, the listener, to understand the distinction between what we call first-party insurance and third-party insurance.
Okay, yeah. So break that down for us. What's the core difference there?
So first-party insurance covers losses that you experience directly. So, for example, damage to your own property. Third-party insurance, on the other hand, kicks in when your actions cause loss or injury to someone else. If you think about car insurance, your car is damaged in an accident. That might be covered under your first-party collision coverage, but if you cause an accident that injures another driver, the coverage for their injuries and damages would fall into your third-party liability coverage.
Right.
General liability insurance for businesses works in a similar way. So it's all about understanding whose losses are actually being covered.
Yeah, whose losses are being compensated.
Correct. Now, for you as the policyholder, it's also crucial to understand that insurance contracts are built on this principle of utmost good faith. This means you have a legal and ethical responsibility to be completely honest with the insurer. Provide all relevant information to them when you're applying for coverage and when you're making a claim.
And what happens if you're not entirely upfront with that information? What are the repercussions?
Well, withholding information, whether intentionally or not, can have serious consequences. The insurer might have grounds to cancel your policy altogether, or they could refuse to pay out on a claim if they discover that you haven't been completely truthful about the risks involved. It's all about that transparency and that trust being the foundation of that insurance relationship.
So for the listener, what are the benefits of having insurance? Why do so many organizations bother?
Well, the benefits are significant. Firstly, and probably most obviously, it provides financial compensation when those unexpected losses do occur.
Oh.
This can be absolutely critical for your survival, especially after a major disruptive event. It also reduces uncertainty. Knowing that you have this financial safety net in place can provide immense peace of mind and allows you to plan for the future with a lot more confidence.
Right.
And it can be a lot more cost-effective in the long run if a major loss occurs that would have severely damaged or even bankrupted you.
Right. That makes sense because, paying a predictable premium is going to be a lot more manageable than trying to absorb a huge unforeseen financial blow.
Exactly. And as we touched on earlier when we were discussing, ERM insurers often offer a lot more than just paying out on claims. These can include expert risk assessments, advice on how to implement loss prevention measures, and even assistance with business continuity planning.
Right. So it's not just about, them stepping in when things go wrong. It's about helping to prevent things from going wrong in the first place.
Exactly.
But, let's be realistic. It's not always smooth sailing, right? What are some of the potential downsides? What are the things that you, the listener, should watch out for?
Yeah, there can certainly be challenges. So claim payments can sometimes be delayed. Disagreements or disputes can arise over exactly what's covered under the terms of your policy. This can lead to frustration and, in some cases, costly legal battles. Determining the right amount of coverage you need can also be quite complex.
Yeah.
If you underestimate your potential losses, you could end up being underinsured. This means you would still have to bear a significant portion of the financial impact yourself.
Right. So that's a scary thought, isn't it? You're diligently paying for this insurance and then a crisis hits and you're still not fully protected.
Absolutely. And while traditional insurance is the most common approach, it's not the only option available for transferring risk. Organizations can explore things like contractual agreements to shift certain risks to other parties they work with. They could establish their own captive insurance companies,
Okay.
which we'll come back to a little bit later.
Mm-hmm.
Participate in mutual insurance pools with other similar organizations, or even using complex financial derivatives in some very specific situations.
Right. And we'll definitely circle back to captive insurance. But what about if you decide to just not insure against certain risks? Is that a viable option?
So risk retention is a viable strategy in some cases. This can take several forms. You might choose to have high deductibles on your policies. You're essentially self-insuring for smaller, more frequent losses.
Mm-hmm.
Or, as we mentioned, setting up a captive insurance arrangement is a form of risk retention for larger potential losses.
Okay.
The key thing for the listener is that insurance is generally most effective for those low likelihood but high impact risks. So the events that could have truly catastrophic financial consequences, like a major natural disaster damaging your facilities or a significant liability lawsuit.
Okay.
It's about providing that financial mechanism for disaster recovery, ensuring business continuity after a major setback, and covering those unexpected and significant spikes in operational costs following a loss.
Okay. So it's really about, protecting against those events that could just completely wipe you out, right?
Now, you mentioned different types of insurance.
Yeah.
Can you give the listener a bit of a guided tour here of what those main categories are? Sure. So we can broadly categorize insurance types based on their primary purpose. First, there are those that are often mandatory because they are required by law or because you have contractual obligations to carry them.
So what kind of situations would trigger those kinds of requirements?
Well, employer's liability insurance, which provides compensation to employees who are injured while working for you, is often a legal requirement. Similarly, public liability insurance, which covers compensation to members of the public or your customers who might suffer harm as a result of your business activities, is frequently mandated or required by landlords or other business partners.
Mm-hmm.
Then there's motor third-party insurance, which is essential for anyone operating vehicles legally.
Right.
Product liability insurance protects you against claims for damage or injury caused by the products you manufacture or sell, and this can sometimes be a legal requirement or a demand from your distributors. And finally, professional indemnity insurance covers you if a client suffers a financial loss due to negligent advice or services you've provided, and this is often a contractual necessity for certain professions.
Okay, so those are kind of the non-negotiables, right? Either the government says you have to have them, or the other businesses that you rely on require you to have them for their own protection.
Exactly. And then we move into the category of insurance that is designed to protect your balance sheet and profit and loss.
Okay.
This includes things like business premises insurance, which covers physical damage to your buildings and their contents from events like firestorms or vandalism. Business interruption insurance is absolutely crucial for maintaining continuity. It helps you recover lost profits and cover increased operating costs if you have to temporarily shut down your business due to a covered loss.
Right. So that's that safety net to ensure you can weather a disruption.
Absolutely. Asset protection encompasses a range of coverages, including insurance for the loss of cash damage to goods while they're being transported, or goods in transit protection against financial losses due to customers not paying their debts, or credit risk and fidelity guarantee, which safeguards against financial losses caused by dishonest acts of your employees.
Oh, wow.
Motor accidental damage covers the cost of repairing your own vehicles if they're damaged in an accident. There's also terrorism insurance available in many markets to provide compensation if your business is directly impacted by a terrorist act. And finally, loss of key person insurance can provide a financial cushion if a crucial member of your team passes away or becomes incapacitated, allowing you time to find a replacement and manage that transition.
Right. So really, comprehensive coverage there focused on keeping the business financially sound in the face of all kinds of different setbacks.
Indeed. And then we have insurance that focuses on employee benefits and protecting their assets.
Right.
This includes a variety of life and health insurance packages, which can offer benefits like life cover for employees' families, critical illness cover income protection if an employee can't work due to illness or injury, private medical insurance, permanent health insurance, personal accident cover, and insurance for injuries or losses incurred while traveling for work. Lastly, there's directors and officers liability insurance, D&O, which protects the personal assets of your company's directors and officers against legal and compensation costs arising from their management decisions.
So it really does cover everything from the physical infrastructure to the well-being of the people who are driving the business forward and those who are leading the business as well.
Exactly. And while most insurance is technically optional, as we mentioned earlier, many countries mandate specific types, particularly those related to liability, to protect the public and employees.
Right. Now, in the article, you use the example of a publishing company. So for the listener, how would all these different types of insurance apply to a business like that?
Sure. So the publishing company would legally be required to have employers' liability insurance for their staff and motor third-party insurance for any company vehicles. But then their magazine wholesalers might demand they have libel and slander insurance to protect against potential lawsuits arising from the content they publish.
Right.
To protect their own financial stability, they'd likely invest in property damage and business interruption insurance for their office premises, as well as credit risk insurance to cover the risk of bookstores or distributors not paying, and goods in transit insurance to cover their publications during delivery. To attract and retain talent, they might offer their staff a package of life insurance. Critical illness cover private medical insurance and travel insurance as employee benefits. And to protect their leadership from potential legal action related to their decisions, they would have directors and officers liability insurance.
Right. So you can see there how a single business can require a really diverse portfolio of insurance coverage.
Absolutely.
And it's driven by these legal obligations, contractual requirements, and proactive risk management. And you mentioned earlier that insurance brokers can play a really key role in navigating all of this for a business owner.
Absolutely. Insurance brokers act as expert advisors who help organizations like yours understand this complex landscape, identify the specific coverages they need, find suitable policies from different insurers, and negotiate cost-effective premiums on their behalf. They're invaluable in ensuring that you get the right protection without overpaying.
Okay. But even with expert help, sometimes you just can't get the insurance that you want, or it's just too expensive. So what happens then?
Yeah, that's a very real challenge.
Yeah.
Sometimes the specific insurance coverage you desire might not be readily available in the market, or the premiums quoted might be so high that they just become economically unfeasible.
Right.
And this is precisely where the ERM approach becomes so critical. Organizations really need to evaluate their actual insurance needs in the context of all the risks they face and the other risk management tools available to them. If the coverage available for a significant risk is very limited or prohibitively expensive, it might not be the most worthwhile investment.
Right.
Compared to, say, investing in more robust preventative measures or accepting a certain level of retained risk.
So it's this balancing act, isn't it, between the cost of the insurance and the protection that it offers?
Precisely. And the insurance market itself, it's not a fixed entity. It goes through what we call market cycles.
Right.
In a soft market, when there's a lot of competition among insurers, premiums tend to be a lot more competitive.
Right.
And organizations might choose to purchase more extensive coverage. However, in a hard market, when insurance capacity is tighter, premiums tend to rise, and companies might look for ways to reduce their insurance spending or explore alternative risk transfer mechanisms, such as those captive insurance companies that we talked about. These market cycles can last for several years and can significantly impact your insurance purchasing decisions.
Okay, so there are these broader economic forces at play within the insurance industry itself,
Yeah.
which are affecting what's available and how much it costs. That's an important factor for the listener to keep in mind. Now, the article also introduces this concept of the 6 C's of insurance buying. So for the listener, what are those 6 key things that they should be thinking about?
So the 6 C's provide a really useful framework for organizations when they're making decisions about their insurance program. The first one is cost, and this goes beyond just the premium that you pay. It also includes any out-of-pocket expenses you would have to cover if you were to make a claim, such as the deductible or excess on your policy.
So it's the total financial outlay, both the regular payments and the potential costs if something goes wrong.
Exactly. The second C is coverage. You need to carefully examine the policy limits, so that's the maximum amount the insurer will pay out in the event of a claim, as well as any specific exclusions and conditions that might apply.
Right.
It's absolutely vital to ensure that the policy really covers the risks that are most concerning to you, and that the coverage limits are adequate to meet your potential losses.
You don't want to find out later that the small print excludes the very thing that happened.
Absolutely. The third C is capacity. So for larger organizations with substantial assets or complex risks, a single insurer might not have the financial strength or willingness to provide all the coverage that you need. Therefore, you need to assess the insurer's capacity, their financial ability to handle those potentially very large claims.
So making sure that they've got the financial muscle to back up their promises.
Correct. Then we had capabilities. Some insurance companies offer valuable additional services alongside their core insurance policies. These might include risk management consulting assistance with developing business continuity plans, or even specialized training programs for your employees.
Oh, right.
These extra capabilities can provide you with significant added value and should be a factor in your decision-making process.
So it's almost like getting additional resources and support beyond just the basic financial protection.
Absolutely. The fifth C is claims. Ultimately, the true value of any insurance policy lies in the insurer's willingness and ability to handle and pay valid claims promptly and fairly. Their track record in claims handling is a crucial factor for you to consider.
You want to avoid, the insurer who is known for dragging their feet or finding reasons not to pay.
Absolutely. And the final C is compliance. For you as a business owner, you need to be aware of and comply with all relevant legal and tax rules related to insurance. This includes things like premium taxes, which can vary significantly from country to country. You also need to ensure that your insurance policies are valid and legally enforceable in all the jurisdictions where you operate.
So it's a comprehensive checklist, really, isn't it, before
Yeah.
you commit? Now, beyond those 6 Cs, what other really important things do organizations need to keep in mind when it comes to insurance?
Yeah, so beyond that framework, there are several other key considerations that can really impact the effectiveness of your insurance program. The financial stability of your insurer is absolutely paramount. You are relying on them to pay out potentially significant sums in the future, so you need to assess their financial health and credit ratings.
That would be, a real double whammy, wouldn't it? If you have a crisis hit and then your insurer goes bust.
And then there's the whole process of claims handling.
Mhm.
As we touched on briefly, the experience of filing a claim, especially for complex losses like business interruption, can be quite challenging
Right.
and time-consuming. And this really underscores the importance of having well-prepared business continuity plans in place.
Okay.
These plans can help you minimize the disruption caused by a loss and potentially reduce the overall size and complexity of your insurance claim.
Right. So being organized can make a real difference there.
Absolutely. Another crucial point to consider is contract certainty. So ideally, your insurance policy should be fully finalized and issued before the period of coverage begins. This helps to avoid any ambiguities or disputes about exactly what is covered, under what circumstances, and for how much.
Right. Get it all in writing.
Precisely. Also, if you're operating internationally, it's important to note that some countries have specific regulations that require insurance to be purchased from insurers who are officially admitted to operate within that country. This can restrict the use of captive insurance companies, which we'll be discussing shortly, and highlights the need to always comply with local insurance regulations.
Okay, so navigating the international insurance landscape comes with its own set of rules.
Definitely. Now let's turn our attention to captive insurance companies.
Right.
Have you come across these before?
I've heard the term, and as we said, it sounds like a really different approach to managing risk. So for the listener, can you explain what they are?
A captive insurance company is an insurer that's created and wholly owned by a non-insurance business. Unlike traditional commercial insurance companies that offer coverage to a wide range of unrelated clients, a captive's primary purpose is to provide insurance coverage specifically for the risks of its parent company or companies.
So it's like a company deciding to set up its own internal insurance division.
Exactly. And this structure allows the parent organization to have much greater control over the specifics of their insurance policies, the premiums they pay, and how claims are managed.
Right.
It's a strategic move, often to address unique or very specific risks that might not be adequately covered in the standard commercial insurance market.
So what are the main benefits for a company that decides to go down this route?
Well, there are several compelling benefits.
Okay.
One is cost efficiency. By essentially bypassing the traditional third-party insurer, The parent company can potentially reduce their overall insurance costs.
Right, so it's keeping those profits within the corporate group.
Exactly. Another key advantage is the ability to design very customized insurance policies. A captive insurer can create coverage that directly addresses the unique risks that the parent company faces, rather than having to fit those risks into a standardized off-the-shelf policy.
So a much more tailored approach.
Absolutely.
Yeah.
And, if the claims experience turns out to be better than anticipated, those surplus funds are retained within the captive and ultimately benefit the parent company's financial performance.
Okay.
Captive insurance companies also often gain access to the reinsurance market. That's where insurance companies buy insurance to protect against very large or catastrophic claims.
Okay.
Captives can often access this reinsurance at better rates than individual companies could obtain directly.
Yeah.
And depending on the jurisdiction where the captive is established, there can also be significant tax advantages.
So a whole host of potential benefits there. But, setting up and running your own insurance company can't be simple. What are some of the downsides?
You're absolutely right. There are definitely important downsides to consider. Setting up a captive insurance company involves significant upfront capital investment and ongoing management expenses. You need to factor in the cost of regulatory compliance, the complex reporting requirements, and the need to either hire or outsource specialized expertise to run the insurance operation effectively.
So a substantial commitment.
Correct. And for this reason, captive insurance companies are often established in specific jurisdictions that are known for their favorable regulatory and tax environments for captives, such as Bermuda, the Cayman Islands, or Vermont in the U.S.
Right.
These locations have well-established legal frameworks and really understand captive insurance operations.
And what kind of risks can a captive actually provide coverage for?
The range is quite broad. It can include traditional risks like property damage, various types of liability coverage, and business interruption. But increasingly, captives are also being used to cover more emerging risks, such as cyber liability, supply chain disruptions, and even employee benefits in some cases.
Okay.
For large companies with complex risk profiles, captives can be a strategic tool for gaining better control over their total cost of risk and tailoring coverage to their specific exposures.
Now, the article also mentioned captives sometimes acting as reinsurers. Can you explain how that works?
So often, a captive insurance company will work in conjunction with a traditional commercially licensed insurer known as a fronting insurer. The fronting insurer is a well-established insurance company that issues the insurance policy directly to the parent company and handles any initial claims processing.
Okay.
However, behind the scenes, the parent company's captive insurer acts as a reinsurer. This means that the captive agrees to cover a portion, if not all, of the financial risk associated with those claims.
Okay.
The fronting insurer pays out valid claims to the parent company, but then gets reimbursed by the captive insurer for the portion of the loss that the captive has agreed to cover. The parent company typically still pays a deductible directly to the fronting insurer.
Right. So the fronting insurer is the familiar face on the policy document, but the captive is the one ultimately bearing much of the financial weight.
Exactly. This type of arrangement allows the parent company to self-insure through their captive while still having a commercially recognized insurance policy in place. Now, there's a potential credit risk for the fronting insurer in this situation, as they are relying on the captive to reimburse them for the claims they've paid out. To manage this risk, fronting insurers might sometimes delay paying out a claim to the parent company until they have actually received the funds from the captive insurer.
Okay.
Interestingly, some captive insurance companies also extend their coverage beyond just their parent company. They might offer insurance to third parties. For example, a large retailer might use its captive to underwrite extended warranties on the products they sell. Or a travel agency could use its captive to offer travel cancellation insurance to its customers.
Right.
This can be a way for the parent business to generate additional revenue.
So the captive can actually become a profit center.
Potentially, yes.
Ah.
To recap the key advantages, captives often provide lower insurance costs compared to traditional insurance. They have better access to the reinsurance market with more favorable terms. There's also a heightened awareness of risk management within the parent organization because they're more directly bearing the financial consequences of losses. They had the ability to obtain broader and more tailored insurance coverage. And historically, though, the significance is lessened. There can be considerable tax benefits depending on where the captive is located.
Right. But again, those potential downsides are still there to be considered.
Absolutely. So the parent company takes on more direct financial risk, because they're self-funding a portion of their potential losses. They need to allocate enough capital to ensure the captive remains financially solvent and able to pay claims. Large claims paid out by the captive will have a direct impact on the parent company's balance sheet.
Okay.
Operating a captive, especially one that provides coverage in multiple international territories, can bring about complex regulatory and compliance challenges, and there's also a significant administrative burden associated with managing the captive's operations, financial reporting, and regulatory requirements.
So a lot to consider for any organization thinking about setting one up.
Precisely. And certain locations around the world, such as Guernsey, Ireland, and Malta, have become very popular as domiciles for establishing captive insurance companies.
Right. Okay, so to recap those benefits of captive insurance, it's fundamentally about, larger companies getting more control over their insurance destiny and potentially achieving long-term cost savings, particularly when traditional insurance options aren't suitable.
Yeah.
And while risk management is a key driver, historically, tax advantages have also played a significant part.
They have.
The key benefits include tax deductions on premiums paid by the parent, the accumulation of funds within the captive, and favorable tax rates on distributions. In some jurisdictions, there's a degree of asset protection from creditors. There's also the prospect of reduced overall insurance costs, better access to the reinsurance market, and the ability to get coverage for risks that are often very difficult to insure through conventional means.
Absolutely.
So quite a compelling list there.
It is.
Well, this has been a real deep dive into risk insurance within this broader context of enterprise risk management. We've explored its history, its importance, the different types of coverage, a practical framework for making decisions, and that idea of captive insurance. Insurance is clearly so much more than just a stack of documents.
It is.
It's a dynamic tool for dealing with the uncertainties of business.
Absolutely. And
Yeah.
this leaves us with one very important question. How sophisticated is your current understanding of risk management? And does it include a strategic perspective on how insurance can be used to protect your organization?
Very thought-provoking. We encourage you to explore how you can tailor your risk insurance strategies to your own specific needs and circumstances. Thanks for joining us.